The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Close to 3 million Canadians are self-employed, and close to 50% of the workforce in Canada work for small business. With me today is Chad Linger, a chartered accountant who specializes in working with small business owners. Today, we're going to learn some tax tips. Welcome to the show, Chad. Great to have you here.
Thank you for having me.
So have you always been a numbers nerd like I am?
I don't know about a nerd, but I do enjoy numbers, but I really enjoy working with my clients and getting to know them and putting problem-solving hat on.
So that's the way your brain works. Did you always know you were going to be an accountant?
I think at one time I thought I would get involved with our family business, and I pursued the designation and just happened to really like the work that I do and have kept pursuing it.
And it's kind of nice not working with the family at times.
There can be some benefits to that as well.
Pros and cons. So the first question that I have for you is small business owners.
Right.
Do they need to incorporate or should they incorporate? How do they decide?
It really depends on a number of factors. So there's tax reasons that might determine whether somebody should incorporate or not. And those reasons are kind of tied to how much money does the business make itself, how much money do the people need to pull out of the business to fund their lifestyle. And the other option would be is if there's an opportunity to income split. So if you have a proprietor that's earning $50,000 a year and they need that $50,000 to fund their lifestyle, then incorporating may not be a benefit to them. But if they have a situation where that business is generating $200,000 a year and they need $100,000 to live off of, well, by incorporating, you can save having to pay that layer of personal tax on that $100,000 that you leave behind at a corporate level. So that's creating a tax deferral, which ultimately leaves more money in their business to reinvest in growing their business.
So money left in the business is taxed at a lower rate.
Because you're just paying the corporate rate of tax on that. You're not having to pay that extra layer of personal tax.
However, at some point when you go to pull it out, that's when taxes are paid.
Correct.
Yeah, a lot of business owners, actually a lot of Canadians, just don't understand that. I often hear from people, oh, small businesses or business owners, they don't pay any taxes. Well, that's not necessarily true. They do pay taxes. And then when they pull it out to spend on themselves, they pay even more taxes.
Correct. So I guess it's just a matter of managing that tax burden for the business owner in the short term and long term. One of the other things that we're looking at too is the income splitting. So if you have the opportunity to income split, so going back to that same scenario where if they need $100,000 to fund their lifestyle and you have a low income spouse, then that's a great opportunity with the right share structure in place to be able to divide that $100,000 between two people. And in BC, I think on $100,000 worth of dividend income on two people's tax returns, so $50,000 each, you're probably going to pay about $7,000 in personal taxes. So that's a real monetary savings to them personally. But also, again, it's leaving the money in the business to help grow that business, which will help grow their wealth.
Right, and a lot of businesses, if you're booming and doing well, you need to keep reinvesting. You want to invest your money where you're going to get the biggest return.
Correct, and most times it's going to be in the business itself, and growing businesses are cash hungry, so
yes.
A lot of the profits end up being invested back into that business.
And then hopefully at some point these business owners are smart enough to know when to take some money off the table to diversify so they don't have all their eggs in one basket.
Correct, correct.
From an income splitting perspective, self-employed business owners have a choice of salary or dividends. There's a number of ways to pull money out. Which is better?
Again, it depends on the situation. So salaries are going to be a deductible expense to the business, and it's reported as employment income in the individual's hands. The reasons where we'd want to consider salary, if somebody is looking to contribute to their RSPs, they need to build up contribution room, which requires employment income. If people have child care deductions, that is deductible against employment income. So again, we need to make sure that we're putting enough salary income in business owners' hands
But it's a higher tax rate to take salary income, but there's certain tax breaks that you only get to use against that employment income.
And in that situation, it's a benefit. The other issue with salaries, though, is that they have to be reasonable. So using salaries to income split is fine if your spouse is active in the business, but if your spouse is not active in the business, then paying them a salary is not reasonable. So in that situation, that's where we would rather use dividends to income split.
So what happens to someone who thinks they're being all clever and income splits with their spouse, but really the spouse doesn't do much for the business, if anything? If Revenue Canada finds out about that, are the penalties huge?
Well, in that situation, the deduction of that salary could become an issue to the business. So most likely it would be denied. So you'd have the tax still being included on the individual's hands that receive the salary, but the business wouldn't get the deduction for it. So you end up with a bit of double tax, which is not a good answer.
So another deciding factor on whether you should incorporate or not might be the number of employees you have?
Not necessarily.
No?
The number of employees, that doesn't really factor in. I think the biggest thing for most business owners, it's really how much money do you need to fund your lifestyle?
Yeah.
And how much money is your business making from a tax perspective. A couple other things that also factor in whether somebody should look at incorporating that are not tax issues would be cost. So initially starting a company, you have incorporation costs, you're going to have compliance costs on an annual basis, filing corporate tax returns, filing annual reports. And also, if you ever want to wind this business down, there's going to be added costs in winding down a corporation, whereas a proprietorship is really simple to get set up, and the compliance costs are limited to just adding the income in with your personal tax return on an annual basis. So the cost is a factor.
Okay. So you have to weigh out all those things.
Yeah.
And what about other tax-saving tips? What kinds of things can you deduct, or are people on top of that already?
Well, the underlying rule with deducting any expenses is it has to be earned for the purpose of earning income, and it has to be reasonable in the circumstances. And further to that, you can't deduct an expense that's capital in nature. So if you're buying new equipment for your business, that's not a deductible expense. The depreciation of that equipment would be deductible. And
so that just takes time. So if you
Yes.
buy equipment, you may be able to deduct a little bit of depreciation over time.
Correct. Also, personal expenses are not deductible in a business. So that's probably where you get into kind of the discretionary spending of things like meals and entertainment or travel.
A lot of gray areas there.
Yeah, and that's something that it's important for business owners to know, that it's better off not to include those expenses in their company, and limit the expenses to the things that are actually related to the business.
Now, one of the things that I do, and it was a tip given to me by an accountant, is if I do take a client or a prospect out for a meal, I write their name on the back of the receipt and what the meeting was about, so that I've got all my records in order. Is that a good idea?
That's a great idea. A lot of people assume, because they use their credit cards for paying for most of their expenses, that, well, I have my credit card statement, that shows me all my business expenses. The CRA does not have to accept the credit card statement as source for expenditures. They want to see the actual receipts. And with meals, it's good to do what you're doing, because it shows a connection between, I've taken out a supplier, I've taken a customer out for dinner, here's who they were. So
you just need to keep your records in order and make sure that you've had a look at what income you need versus the income of the company, because that's going to have a big decision or a big factor on how you decide to incorporate or not.
Yeah.
Chad, thank you so much for being here today.
Thank you for having me.